Gentlemen, good to have you both with us. First of all, I just want to say, if this was a sport, let's say it was football, there would be a lot of armchair quarterbacks right now, right? Second guessing what the Fed is doing. But I want to start with you, Stephen. What do you think the Fed is getting right?
Well, they fell way behind and they let inflation get out of control. And unfortunately, they don't have the luxury of looking around the corner and hoping that maybe things will slow down and everything will turn out all right. I think they have to wring inflation out of the system, and that means finishing the job, as Chairman Powell and others have indicated.
All right, Ed, is there anything that you think the Fed is getting right?
Well, I think they got things wrong for sure back in August of 2020 when they decided to prioritize getting the unemployment rate down and not worrying too much about inflation. And now, they are trying to catch up to the inflation curve, but they've done quite a bit. I mean, since March, we've had 300 basis points in increases in the Fed funds rate. And I think what the Fed is really not paying enough attention to is that the strong dollar and QT2, this quantitative tightening program they're on, they're equivalent to probably 50 basis points each. So I think there's, when you look at the whole package of monetary tightening, they've already done quite a bit. And I think it would make sense for them to do maybe one more 75 basis point hike in early November, but then pause and just see how this whole thing plays out. The big risk is something will break, and then they'll be forced to bring interest rates down before they've actually brought inflation down.
Stephen, we saw the Fed tapping the brakes like this as soon as it saw signs that inflation was coming down a bit in the 70s. Did that work out then? And could you apply those historic lessons to today, 2022?
Well, Chairman Powell has brought up that exact phenomenon from the 70s, talked about it at Jackson Hole, and a number of other Fed officials have taken up that same argument. And basically, what they're suggesting is that the Fed has to err on the side of being aggressive rather than of stopping too early. And, I think until they see more concrete signs that the labor market is cooling and more importantly, that inflation itself, underlying inflation is cooling, it's just hard for them, I think, to stop at this point. I think, they have to reestablish their credibility. And that's going to require, as they've said, taking rates to a significantly restrictive stance. And most of the Fed officials are saying they don't think they're quite there yet. They've gotten to neutral and, maybe at the top end of neutral, but they still have a ways to go in their view.
You got, Ed, rates, quantitative tightening, you got a stronger dollar, all of these things acting as restraints on the economy. It's very hard to practice this kind of tightening without breaking some glassware along the way. Yeah. So my question for you is, what is the bigger long-term risk to the U.S. economy? Is it high and sustained inflation, or is it the risk of a painful recession? What's the bigger risk?
Well, I think right now they kind of go hand in hand. Steve made a good point that the Fed officials are saying that they want to raise interest rates until inflation comes down, until it's restrictive enough. I think that's just another way of saying that they've decided that the only way they're going to bring inflation down is with a recession, and that can create all kinds of other problems. And so instead of going on this roller coaster ride between the Fed and the economy, I think could they be wise after 300 basis point increase since March? In 7 months, they've gone 300 basis points. I think, give it a rest after the next hike and see how things play out. They're not going to be bringing inflation back down to 2% anytime soon. They have to acknowledge that bringing it down is going to take some time. If you do it too rapidly, you're going to get all kinds of unintended, wicked consequences coming along with a recession, with a credit crunch, and the global implications won't be very happy either.